A.V. Rajwade joins us. Thank you so much for joining us, Mr. Rajwade, and apologies for hitting you so late. There was a bit of a breaking news that had come in from the Supreme Court. So we've hit you slightly late today. Let me start off by asking you about the IIP and inflation. How do you put those two together, and what are the connections?
Well, the connection is that at least in our case, the main fall in inflation has come because of food prices. Now, in my view, interest rate policy or monetary policy have very little to do with food prices. It's much more a sort of supply side, to use a bit of jargon, problem. So I don't think we should give credit to the central bank for bringing down food inflation. I think what the monetary policy has done is that demand for other goods, particularly industrial goods, seems to have softened. That is getting reflected in that has been reflected in the IIP numbers. I think the latest data I remember is that last month's car sales were also down by about 1%. So I think generally the improvement in inflation seems to be coming at the cost of a lower demand in the other sectors of the economy. And I'm not sure that that's a very good thing in the long run. I think we do need growth, particularly manufacturing growth. Our Prime Minister has Make in India as his slogan. So I think the numbers so far, and it is probably too early to judge him or judge his performance in relation to his objective. But yes, so far there are no signs that industrial growth is picking up, certainly not manufacturing.
Yeah, people in Maharashtra and Haryana are going to probably give a preliminary judgment tomorrow. We'll wait and see how that comes out on the 19th. But I'll come back to Make in India later. You know, there is a view that actually what the RBI, if one looks at the repo rate, for instance, it had been between 8.5 to 7.5 now for almost 3 years. Some would argue that it's actually not affected inflation at all. Inflation is largely imported based on commodity prices. When commodity prices globally have slowed down, inflation's come down. Food price inflation, as you are arguing, has nothing to do with interest rates overall. And there is a view that perhaps interest rates are held up largely for portfolio investors.
Well, if we have already allowed our equity prices to be fixed by a couple of dozen foreign fund managers. Now, with the larger amount of investment permitted in the debt market, and I think the governor has made an announcement that in 2 years' time all limits on investments in the debt market will go. I think even interest rates, domestic interest rates, will be governed by foreigners. Now, I don't really like that. I think what we need is a monetary policy, a fiscal policy in the interests of the domestic economy, not what is determined by a couple of dozen fund managers. There is, I think, one other perspective to that whole issue of interest rates and inflation. I think if we take a look globally what's happening, I think despite their best efforts, Japan and Europe are unable to raise the inflation as they would like to. They are targeting a 2% inflation. They are not able to do that, nor is the US. Now, this is despite 4 or 5 years of extremely easy money and interest rates which can hardly go down further. And despite all that, inflation is nowhere on the sign, nowhere on the sight. And I think what this once again suggests is how much influence the demographic pattern of a country, of an economy, has on the demand side and therefore on inflation. And I think that's one variable which you are forgetting. We are one of the youngest major economies in the world by terms of average age. We are still, the population size is growing. The number of people joining the job market is continues to grow each year, while in most of Europe and Japan, the situation is exactly the reverse. So I think monetary policy has limitations in terms of influencing the inflation rate where it wants to. Even in the US, despite a lot of our younger immigrants, much more compared to say Europe and far more than in Japan, I think even there the latest number suggests that inflation is nowhere in sight. So I think the Mr. Friedman's that inflation is always and has always been a monetary phenomenon doesn't seem to be holding good any longer.
So let's look at what is happening to crude prices. The fact that crude prices are going down, and it has nothing to do with our own demand. Does that give us a space to actually not bother that much about the rupee? Can the RBI actually allow the rupee to depreciate, go closer to 70 levels?
I would certainly hope that they look at it from that angle. Yes, oil prices have come down. In fact, to me, that was a major surprise, given the sort of kind of what shall I say, major conflicts which are going on in that part of the world. In Iraq, Iran could be drawn in it. They are very close to Saudi Arabia. I think the whole region is in a turmoil, and still oil prices are softening. As far as the rupee is concerned, I would certainly agree with you that this would be a good time to allow to make the rupee closer to where the trade deficit can start coming down. You know, it's remarkable that oil is our largest single item of import. Oil prices have come down, but the sort of first quarter's data, trade data which came out, trade and current account data which came out, suggests that the trade deficit is not going down at all. So I think what it means is that the non-oil numbers have worsened to the extent the oil import bill has come down. But yes, I would agree. I think the policy makers need to take advantage of this situation from two different angles. Number one is I think it's a good time to announce the elimination of all subsidies on petro products, which will help the budgetary process release some funds for investment as distinct from subsidies. And the second, as the point which you made, namely sort of dried out the rupee, so that the domestic industry,
because make in India becomes meaningless if your rupee is overvalued, right?
I would completely and totally agree with you. I think if you look at all that we need to do is look at what has happened north of our border. I mean, I am a great admirer of what the Chinese have done. I think they have managed their exchange rate, and today it is the not only, even according to the IMF now, it has become the world's largest economy in purchasing power parity terms, the world's largest trading nation, world's largest exporter, and I think also their growth record is something which no other country has ever matched. So I think as I keep saying, we need probably to learn much more from Beijing than from Washington.
Even with the RBI does not intervene, Mr. Rajwade, once US interest rates start going up, although yesterday it's true that bond yields have actually gone down, if US interest rates start going up and the spread between Indian interest rates and US interest rates narrow, do you expect some portfolio capital to go back to the home country and therefore put a little bit of pressure on the rupee?
Well, that's sort of one way of looking at it. I think our governor certainly is in a way concerned about that possibility. He is wanting greater international monetary cooperation and so on and so forth. Yet, one can equally well argue that high interest rates in the US would mean softer equity prices.
Yeah.
Because generally it is believed that higher interest rates are not very good for equity prices. The bond prices will also fall. Bond prices will fall, yields will go up. Now, it can as well be argued that in that kind of a scenario, the investors in those markets today might look out for higher returns elsewhere. So there could even be a capital outflow. So I think what too often too many of us do is indulge in retrospective rationalization of what has happened, because it can either can be rationalized. I think we do not have any major scare around the world at the moment which will drive money to the US dollar or to US shores. So I think the possibility of a rise or the actual rise whenever it takes place, 2015 or even 16 now, in my view not necessarily will lead to a capital flight from India.
Let me focus a little bit on Make in India. I don't know whether we had you, Mr. Rajwade, after the Make in India speech from Mr. Modi. And what I could make out from that speech is that the focus clearly is on employment. Now, there is one way to say that, yes, our focus is going to be on employment, but to ask corporates to focus on employment is a little difficult when their main focus is likely to be on profits, right?
Yes, I think that the reality is that an overvalued rupee squeezes corporate profitability because it disallows them from increasing prices, to be able to compete with imports, and to that extent they would be reluctant to if they are not very profitable. I think we need to make an environment where the investor feels reasonably confident of returns on his investment, and I think we come back to that question of the exchange rate and its competitiveness. I think that affects competitiveness much more than the interest rates. I think interest rates probably get overemphasized, but let's look at it. Interest as a proportion of top line for the corporate sector, I think is not more than 2–2.5%. So a 1% rise or fall hardly matters to their profitability. On the other hand,
is much more
the change in the exchange rate directly affects either costs or realizations in a much more severe fashion.
So, effectively, you are saying that inflation targeting is not what should be done, right? Inflation is not really the problem. The problem is earnings.
Yes, I mean, I personally am not a great believer in inflation targeting. The first central bank to adopt that was the New Zealand Central Bank, of all the places. It didn't work there. Now Europe and Japan and to some extent US are trying it in the opposite direction of using monetary policy to increase inflation. That is not working. So I think there are limitations which we need to accept on monetary policy being such a great influence on the rate of inflation.
Right, Mr. Rajwade, thanks so much for coming and talking to us on the show.